switch for it.
Looks like we got someone not on mute yet. I'll try to look for those as well. And then if you have any questions, please use the chat box and we will start. I'm going to kind of do an introduction here for Taylor Leary. I'm so excited that he gets to join us today. Taylor is a certified financial planner and owner of 4 Points Wealth Management. He's been working directly with clients to help them navigate the investment, financial planning, and wealth management world since about 2009. What really sets him apart is his passion for behavioral finance, which is the influence of psychology on investor behavior and its effects on the financial markets. And he helps his clients build comprehensive financial plans for retirement, wealth management, and other financial aspirations. He's a graduate of the University of Colorado Boulder, and he lives in Inglewood, Colorado native. He grew up in Steamboat Springs, an avid adventure athlete, and loves spending time with his wife and 2 daughters. And we are so incredibly grateful for you being willing to spend some of your time with us here today. So I will hand it over to you, Taylor, and thank you so much.
Well, thank you, Ashley. It is absolutely an honor to be a part of this event. And I hope for all of our folks out there, they can get a little bit of value over the next hour or so. So the first part, really going to be talking about kind of the financial basics and some of the things that I work on a regular basis with individual clients. And my hope is that when you walk away from here today, you will have a better grasp of maybe your personal financial situation. Really the idea here is this concept around mindful wealth, and it really ties in well considering what the CCCS group has been doing over the last several months, incorporating this mindfulness. And this is more important now than ever. And I'm going to talk about what that means to me, mindful wealth. But right now with the pandemic and all of the things that are happening in this environment, there's an isolation effect that's happening with a lot of folks. And I think people are getting inside of their own heads, and the market's all over the place. It's reaching new highs, and there's just a lot of uncertainty out there. So my hope is today, after, today you'll have a pretty good grasp on kind of maybe what direction you want to take in your financial life. So with that, I'll kind of start here. So what we're going to be covering today, the first piece is going to be financial or wealth management basics. So what is it that I do, and how can that be a benefit to you? Because I think that there's more than just the investments that are involved in working with a financial professional, or even in your own financial life. It's not about what stocks you own necessarily. There's a lot that goes into that. So we're going to dive into that a bit. Wealth building basics. I was fortunate enough to get a bunch of pre-questions around kind of the different basics around, how to build wealth, whether it's increasing your income, doing the side hustle, how to invest better, those sorts of things. So we're going to talk about the wealth building basics, and then insurance. This is going to be a part of the conversation that is going to be very important, as how to protect what you have. And then the investment. This is the sexy part of what I do, and what a lot of people want to get down to the brass tacks of what it is that I do from an investment perspective. And then finally, behavioral finance. As Ashley mentioned, I love behavioral finance. I think that this is something that drives really the success or failure of so many people's financial lives, is basically what happens when their behavior overrides the logic and their emotions. And so I'll dive in a little bit there on what you could expect, or how to manage some of the behaviors of what you're doing. So without further ado, I'm going to dive right into it. So who am I? My name is Taylor Leary. I'm a certified financial planner and wealth advisor. I am the owner and president of 4 Points Wealth Management. And I just want to first start off and thank Ashley, and then also Kay Fallberg, for inviting me to be a part of this event. I think personal finance is a very important element to everybody's world, but I think that that's because that's the world that I operate in. But I think that there's a certain level of interest that everybody has, because money is inherently so emotional. And that is really what I believe sets me apart from a lot of folks, is that I'm going to be digging into not just, what your investment strategy looks like, but what do you ultimately want to achieve in your life, and using that philosophy to help you, go through the various stages of your life, whether that's, just getting up and started with your investing, trying to send a kid to college, or trying to retire. There's a number of things that I can help you with. And I'm excited to share some of the knowledge with you today. Use the chat feature to drop in questions. Ashley's going to kind of be monitoring that. And so my promise to you is that we'll try to do our best to get to everything. But my hope is that you walk away a more savvy investor, a more savvy individual for your personal finance. And hopefully we can answer some of those questions along the way. What I will do is I'll take a little bit of a pause between each segment. So I believe there's 6 segments here, and I will take some time between each of those to discuss, or at least maybe check the chat box before we move on. If it does end up being a little bit too personal in nature, in the sense that the question is more specific just to you, I might do a little bit of a timeout, do my best to answer it kind of generally. But I will provide my contact information at the end of today's session so you can connect with me. I will also provide the last 15 minutes or so for the Q&A part of it. So look forward to that if you want to. And also, don't be worried about asking those questions, because if you're asking it, there's a darn good chance that somebody else in the room is thinking the exact same thing. All right. So what is mindful wealth? Well, it's a very simple process, or a very simple equation. It's meaningful prosperity and financial vitality. Now, what do those mean? So meaningful prosperity is understanding the why behind what you're doing from a financial perspective. This is diving into kind of, the purpose, that purpose-driven life approach. This is kind of getting into the mushy-gushy stuff of why you're trying to do what you want to do. I have people come to me a lot of times and say, well, I want to retire when I'm 55 or 50 or 45, or I want to retire early, or I want a Maserati, or I want a second house in Vail, or all of these things. And my question to them oftentimes is why? Because if that's just, if that's something to fill a hole in your life, maybe there's some other avenues that we need to work on. So the meaningful prosperity part is really trying to understand the person and really understand the family unit on why they're trying to achieve what they're trying to achieve. And then financial vitality. That's going to be a lot of today's focus. The financial vitality is kind of the blocking and tackling, so to speak, to the financial view of, and kind of like what you're doing in your financial life. So, budgeting, cash flow management, investing, those are some of those, the vitality pieces that really kind of are the nuts and bolts and sort of the foundation of what you're doing from a financial perspective. So that's kind of my approach on mindful wealth, is inclusive of those 2 topics. So what is wealth management? What is it that I do specifically? Now, for me, it's really simple and can be broken down into basically 4 core grids. The first is going to be financial planning. As I mentioned and Ashley brought up, is that I'm a certified financial planner. And so I've taken the time, effort, and energy to actually get certified at the highest level to provide the best financial services that I possibly can. And this really starts with financial planning. So this is really going to focus on kind of those basics. So, what is your current income? What's your expenses? What do you really want to ultimately achieve in your life from a financial perspective? And then what are the things that we need to do to help coordinate that? So the financial planning piece is very important. And really everything kind of leads back to that, because I do take a planning first approach. And then we look at investment management. Again, I've kind of said this before, but it's a lot of the times people want to jump to the investments and just dive right in there. But first we need to understand, because the investments are going to be the vehicle for which you're going to take the money that you're investing, and you're going to try to achieve the stuff that you've put into your financial plan. And so the investment management piece is very important, and we'll talk a little bit about that here in a minute. And then then we've got financial education. So financial education is why you all are here today. This is something that is near and dear to my heart. I've done dozens and dozens, if not hundreds, of different seminars, both publicly as well as at my former job, in more of a private setting, but also with individuals on a one-on-one basis, is really provide that financial education. So I really honor all of you here today in the concept that you're here. I mean, that's half the battle. So you're developing your financial savvy by just being here. And that's really near and dear to my heart, which, is, I guess, maybe why I got the nod here today is financial education is very core to the wealth management process. Knowing what you're doing and how things work is extremely important. And then finally, ongoing engagement. You might be maybe scratching your head. Why does this have anything to do with wealth management? Well, just like anything, if you put the seeds in the garden but don't water it or don't pick the weeds, then things are going to get a little bit out of control. And I see this very often, is that people have the best of intentions when they start their financial path or they're on a journey, and they don't have that continual engagement. Now, I'm not talking every single day, but periodic touching base with a financial professional like myself, or even sitting down with your spouse and having these discussions. So the ongoing engagement element is huge in wealth management. So I hope that provides a little bit of context of what I do and how I provide value to my clients and the people that I work with, and maybe how you can apply that to your own individual life. All right, so how do we build wealth? Actually, before we do that, Ashley, do we have any questions that have popped up that are worth noting here? Let me just.
No, nothing. No, we just had a comment about your beautiful family.
Oh, well, thank you. Thank you. We were down in Sedona here a few months ago for my mother's 70th birthday and did some family shots. So thank you very much. Really appreciate that. All right. So how to build wealth, excuse me. So it's a pretty simple concept. I'm gonna put these two bullets up here first. It's that your income is greater than your expenses and that you invest what's left over. That's kind of the basic thing. One of the interesting aspects that I think a lot of people maybe get confused by, or not necessarily confused by, or they lose track of, is that your income is the greatest driver of your wealth creation, single-handedly, because it's going to be it's foundational. It's absolutely the centerpiece of how you build wealth. And so you might want to talk about, adding more income streams, but in the core of it, it's your income that matters. And as long as your income is greater than your expenses, then you're going to most likely be in a good spot. All right. And then it's what you do with the remainder of that money and invest it or save it is going to then predicate what you can do with that ultimate situation. So when I say that, it's very simple. Income greater than expenses, and save and invest what's left over. It's really that simple. But you've got to have the patience to be able to do that. Now, in kind of leading up to this event, there was a couple of questions that were asked that Ashley sent over to me. And it was in regard to kind of the budgeting, because this is going to be a big piece. We see this a lot in the United States, that debt, credit cards, or what I consider bad debt, really kind of consumes a lot of people. And that's oftentimes because the expenses are actually greater than the income, and those things are offset. And so we start to get into this debt cycle, which can be a little bit challenging. Now, that's not necessarily everybody, but I believe that everybody can benefit from budgeting. All right. And you don't need to be hardcore about this. This can be something that you kind of do as just a practice. And I think about budgeting and a lot of kind of like weight loss, really. There's so many people that struggle with the weight loss thing, is they're constantly feeling overwhelmed by it, because there's a lot of guilt and shame around, what they're spending money on. And oh, I know that's bad that I go to Starbucks. Well, you know what? Let's remove that. So take a non-judgmental approach to budgeting. Just lay it out flat. This is where I have a lot of conversations, especially with spouses, the husband and wife. One of them has one relationship with money and the other has another. And oftentimes they're at odds with each other. And I've had a situation where the husband liked to spend a lot of money on various items, you know, for his garage, and the wife wasn't that excited about it, but she spent money in her own ways. And so there's a little bit of a challenge there. And really, when it comes to budgeting, just start with where you are now. My recommendation to you is to take the last 3 months or 6 months, but usually the last 3 months usually gets everything kind of encompassed, and take your last 3 months of your bank statements and plug those things into a spreadsheet. There's also tools out there that can help you identify different holes that you might have. There are things that I have on my end, the tools and strategies that I can help create a budget if that's something that you're looking for. But there's a lot of different things out there. And then understanding the different categories. What's going to home maintenance? What's going to healthcare? What's going to, you know, the kids' practices and sports and extracurricular activities? And then what you start to find is where things just kind of going black. They're going out into the dark hole, and you're just not sure where you're spending it. Just by taking a non-judgmental approach to that and just categorizing things, you can start to see that maybe, just maybe, you're spending a little bit much money in certain areas. And this isn't necessarily the case for everybody, but I've had folks that use a budget and it ends up being like found money. And what I mean by that is they look at it and they're like, well, gosh, we just stuck to a budget and all of a sudden we had more money to invest. And so don't look at it as a punishment, but look at it from a success side. What could be possible if we were a little bit more, and it's only incrementally better at managing our money. The other side of this, and I'll talk about this here in a little bit, is the idea of saving and putting money away at the front end versus at the back end. Warren Buffett, who I like to follow a lot, is very famous for saying a lot of things. But one of the things that he talks about is, from a personal finance perspective, is make sure you save first, because if you wait till the end of the month and say, oh, whatever's left over, I'll make sure I save. Well, we have a propensity to fill up the bucket. And so we'll spend whatever is there. That's part of the behavioral finance side of things. So you can start to see how all of this stuff is tied together very intrinsically. Then build in some wiggle room. Building in the wiggle room is very wise, because, you know, and what I say is, you know, somewhere between a 10 and 20% buffer on a monthly basis, meaning try to budget below that level of what you absolutely think you need. The reason for that is that it allows for any error. Okay. You know, if something happens for, you know, gosh, I don't know, an expense where you've got to get maybe some snow tires or something like that, you know, that really kind of accounts for some of those budgetary shortfalls. And if you don't account for the wiggle room, then you're going to be kind of on that razor's edge. So I would say build in that wiggle room, build in that little flexibility there, and don't just totally be a slave to it. You know, if you say you're going to spend $100 a week at the grocery store or 200, whatever the number is, you know, if you go to 205 or you know, 210, it's not that big of a deal. All right. That's the idea here, is that we just don't want to be a slave to it. And, you know, just make sure that, you know, on Cyber Monday, you just don't absolutely go nuts. You know, Amazon is fantastic, but, you know, sometimes, you know, they've started to figure out that, you know, we really like to open those packages. So just be conscious of it and take some time and stay engaged with it. So readdress it every 3 or 4 months. Just sit down. Again, taking that non-judgmental approach with it, looking at, okay, we budgeted for X and we ended up spending Y. What was the reason for that? It might be more, it might be less. And then figure out what you want to do from there. And then finally, be pragmatic. You know, I talk about this. My mom and dad are both in retirement, and you know, they did a good job of saving money and spending wisely, things like that. But my mother loves jackets. They live in Steamboat Springs, and so it's, you know, there's a very bizarre, you know, cycles of weather where it could be sunny in 1 second and 5 minutes later it's -5 degrees. And so she loves jackets, and she just knows that. So she kind of has this little budget of how much she can spend on jackets. I mean, the woman has jackets for every 3 degrees in temperature change. And so the idea here is just be pragmatic with how you're budgeting. And if you like to go to Starbucks, put a Starbucks bucket there. Just think about it in that frame, is that you shouldn't put guilt and shame on the money, because what that then does is creates this scarcity mentality around money. And far too often I see a scarcity mentality as opposed to abundance mentality, meaning that there's a high likelihood that you're not going to lose your job next month, and that money is going to be there in the next month and the next month. But be smart about the steps that you're taking at every single level. We're going to move on. Ashley, is there anything that jumped up in the chat box there?
Nope, nothing yet.
Nothing yet. Perfect. All right. So now we jump into the insurance planning piece. All right. So insurance is there to protect what you have. There are a host of insurances out there. I mean, gosh, you've got pet insurance, you've got house insurance, car insurance, life insurance. You can use annuities to insure your investments. I mean, gosh, there are thousands and thousands. I mean, you can pretty much insure just about anything under the sun. And so really, it's about protecting what you have. All right. So today I'm really going to focus a lot more on like the life insurance piece and kind of how that can fit, or the different pieces that you might need over time, because your insurance needs will change. All right. If you're just starting out and you know, you're 25 years old, you're just getting into the business of whatever that is, you know, making sure that you've got health insurance, get the proper health insurance, because that's going to be probably your biggest risk at that point in your life. And then as you get married and have kids and things like that, and you add different things to it, then life insurance and disability insurance are going to be paramount. And then as you get older in life, you want to think about some other types of insurances. So I'll get to that. And then I'm going to jump into some life insurance basics, because that's generally what a lot of people talk about and kind of know. So how insurance changes over time, or insurance needs change over time. As I mentioned, you know, when you're younger, you don't necessarily have a big insurance need. You know, everybody's got to have car insurance if you want to be driving on the roads. If you own a house and you have a mortgage, the mortgage company, the bank, is going to make you have homeowners insurance in the event that, you know, something happens to their house or to your house, sometimes their house too. But understand kind of those things. But really, one of the fundamental aspects is, especially if you're adding, you know, building a family, having life insurance is very critical. This is, you know, in the event of the worst, is that if you pass, what happens to your family, and what burden will they have? They say that if an individual dies, you know, husband and wife, it's not that their expenses are cut in half. They might be cut by 10 to 20%, but in reality, half of their income just got chopped off. If you're a stay-at-home spouse, if you're taking care of the kids, I mean, these things really matter. What's going to happen? I have two small children that are both in daycare. And if anybody's seen what's going on in the daycare world, I mean, it's astronomically expensive to send them to daycare. So what happens if something happens to me? I want to make sure that my family's taken care of. And so there's a number of different things that we can put together as far as how do you account for, you know, like how much life insurance should you have? Oftentimes what they do is you take your income, multiply by 6 or 10, and that's really what your insurance need should be. So let's just say you make $100,000 in income. You should have $500,000 to $1 million in insurance coverage, life insurance coverage. But that's not just it. You know, you're not just stuck there. The other side of it is disability insurance. Disability insurance is very important for those that are in that accumulation phase. So when you're right out of college, you're starting your working career, and then until you retire, having that disability insurance is incredibly important, either short-term or long-term disability, because you know, living in Colorado, I at this point, I'm pretty sure that everybody on the chat here or on the call today is living in Colorado. We live very active lifestyles. Now, if you're like me and you like to go maybe hiking or mountain biking, you know, there's some risks to that. Now, the risk of dying while you're mountain biking is relatively low. So, you know, having life insurance is certainly important, but the risk of getting hurt is incredibly high when you do some of the activities, going skiing. And it's not necessarily yourself, it's the other skiers on the mountain. So when I say that, having disability insurance could benefit you if you go out of work for a couple of weeks or a couple of months. Having that short and long-term and or long-term disability is really important. And again, understanding what those, what that coverage looks like is incredibly important. But as you get older, certain things change. So, let's just say, now you've gone through your life and now you're hitting retirement, and now it's just you and your spouse, and you have your house paid off, and things are kind of looking pretty good. You don't have a lot of debt. You don't have you're pretty well figured out. Well, the life insurance need isn't necessarily as great as it once was for the average individual. Now you've got to consider maybe some of the stuff that's happening in your older age. So what it looks like for long-term care insurance. Long-term care insurance is a type of insurance that would cover you if you were to go into a long-term care facility, or you might have a life event that would, basically it's defined, a long-term care event is defined by failure of 2 of the 6 activities of daily living. So when I say activities of daily living, think about what happens when you wake up in the morning. You get out of bed, that's one activity. You go to the bathroom, you go to eat breakfast, you get changed, you take a shower. All of these things that happen in your morning routine before you leave the house is part of your activities of daily living. And so if you fail 2 of the 6 of those, that could be considered a long-term care event, especially if it lasts for more than 60 days in most cases. So when I say that, the needs from when you're starting your career till when you're in or near or beyond retirement really change over time. And that's really understanding kind of the insurance needs. Just because you're 60 doesn't necessarily mean you have to have life insurance, but it probably makes sense to have some other type of insurance to cover what you've built. As a reminder, insurance is there to protect what you have. I don't necessarily use insurance all the time for building wealth. It can certainly be that, but there are certain things that are out there. And I'll talk about some of the life insurance pieces here. Ashley, are we seeing any? Let me just go here in the chat.
We do have a couple. So you kind of mentioned that scarcity mentality, and
Yeah.
so I was talking about how real that is right now, especially during COVID times. Do you have any insight on how to deal with that if you're feeling unstable or feeling that scarcity mentality?
Yeah, it's hard. I work with a couple of different men's groups, and it's really for my own kind of self-help. I work out. There's a lot of things that I do personally, but I've been feeling it as well. You can feel isolated in these times. I'm going to talk about the scarcity mentality here in a little bit, kind of at the end as we kind of get into the behavioral piece. So I think it's Anna here put that in there, and I love that. Do you have any insight on how, if you're feeling unstable? Well, I don't know where that is exactly, but or where that's coming from exactly. If unstable financially, unstable, emotionally, those things. But there are certainly some things that you can do to kind of work through that. I am looking at Pat. Is insurance really necessary? Again, I'm going to absolutely say yes. Depends on what type of insurance, but there's some things that you should absolutely absolutely look at. It says, Ashley, are you hearing me?
Yeah, I hear you just fine.
Okay, it just says no sound from presenter. So
Yeah,
I don't know if that's a
Pat, if maybe you hit a mute on your own, check your sound down below on the bottom left.
And then also, Pat, just jumping into the credit card debt, I'll talk about that here in a minute. Awesome. Thank you, Tony. I figured out how to put the chat on another screen so I can kind of do everything here. It's beauty. All right. So life insurance basics. All right. So we're just going to kind of dive into this a bit and look at term insurance. Now, for me, again, we talked about kind of the basics of life insurance is that anywhere between 6 and 10 times your income is really kind of a safe, healthy space. So, 5 to 10, we'll just call it, but typically in that range. So if you make $100,000, having $500,000 to $1 million in life insurance or death benefit, as they call it, is really important. I use term a lot of the time for my own personal use as well, because it's really you get the most bang for your buck. Okay. And why I say that is that you can get quite a bit of life insurance, obviously dependent on a couple of different variables, but you can get a lot of it for kind of the smallest amount of money. And terms typically are, as short as I believe 1 year, 5, 10, 15, 20, 30-year term policies. For me, it's really kind of looking at the landscape and saying, okay, what is really kind of my time horizon here? If you're in your early 30s, mid 30s, 40s, your time horizons are different on exactly when you need that. One of the strategies that I look at, and typically when clients come to me and they say, well, how much life insurance should we have? And so we start to do an analysis, and I've done a lot of these for a lot of folks. So if you are in that camp, I'd be happy to run an analysis for you. But one of the things that we want to cover is the mortgage. So as an example, if you're in Colorado, our property values tend to be higher. So, obviously mortgage rates or mortgage balances are typically higher. So let's just say that on average, an individual has $300,000 in mortgage, okay? Seems pretty reasonable. Then we would at the very least want to have that covered. And the reason that I say that is that if you were to die, and let's just assume you're married, your spouse is going to be taking on that entire burden of paying that mortgage. And so having that or having that chunk of money to be able to pay off that mortgage is absolutely imperative. And so I'm very big on that. And a great use of that is term, because as we know, we can pretty well see what our term is on our mortgage, whether that's a 15 or a 30 or somewhere in between, or even less than that. We can really kind of navigate that pretty well. You say, okay, I just took out a 30-year mortgage for $300,000. Well, let's just take out a 30-year term for the same amount of money. That's a really good way to do it. So that said, that's kind of a good way to do it is term, and then permanent. Permanent is kind of, as it suggests, is that you buy it, you own it. So the difference between term and permanent is term, you're kind of quote unquote renting the policy. When you get to the end of the time, let's say it's a 10-year term, then you just paid your premiums and you really have nothing to show for it if you didn't actually use the insurance, if you didn't die. And that's kind of the only way to really use life insurance from term life insurance specifically. And so you kind of are renting the policy. So, you got that peace of mind, you paid for that, and there's some value to that, absolutely. Now with permanent, when you're paying premiums, you're actually building up what they call cash value. And it's something that can be there for, if you do it right, forever. So that's certainly something that, a lot of people look to. And it's usually in the form of whole life or universal life. Now, we'll talk about, today's not the great spot to talk about the nuances of the difference between the two, but basically permanent is a great way to build what they call, again, cash value. Cash value is something that grows over time. Some people use permanent insurance, life insurance, as a vehicle for investing, all right? There's a couple of different things that you can do because permanent can have an underlying investment to it that will build that cash value quicker and kind of help you in the end build that up, because then you have something to show for it. And what's great is that because of the way the tax laws are built is that you can actually pull that cash value out as a tax-free loan. So some folks use permanent insurance as a way to build some of their wealth or tax-free income in retirement. Sometimes a great plan. The challenge there is that you've got to be very dedicated to it. It's not something that you got to, you're in and out in a couple of years. You've got to be kind of dedicated to it for, the long haul. I would say 15 to 20 plus years. So kind of consider that. But it's a great way to, you don't get the same death benefit, but it can provide some sort of a death benefit as well as building the cash value there. And then you've got the hybrid approach, which is, something kind of in between the term and permanent. So term kind of, it can be, the insurance world's huge, and you can actually have a return of premium built into a term policy. So all of that premium that you paid in can actually get paid back to you. Now there will be a cost of insurance that's involved, so it's not a dollar for dollar return on money, but it can be a decent way to save. So I've seen some folks use term policies as a kind of a bit of a savings account, hedging their bets, so to speak. So, let's just say we use you're sending a kid to college in 20 years, and you get a 20-year return of premium term policy. Well, what happens is that at the end of that term, you can have some of that premium that you paid into it actually pay out to you. So it could be a great way to kind of set aside some money, because along the way you had a death benefit. So if something were to happen to you, you would have that lump sum. So another good strategy, or can be a good strategy, depending on your situation. And then some other considerations is, health. Shop it around. Just like your cell phone, life insurance changes over time, and oftentimes it gets better. And so if you've had a policy for 5, 6, 10 years, it might be worth shopping around, because just like your iPhone 7 used to be really cool, well, now they've got the iPhone 12, and that thing's like, that'll pretty much do anything for you. It's a supercomputer in your pocket, and it makes the iPhone 7 look like you're on dial-up. And so the whole idea here is that over time, life insurance changes. So go back, because oftentimes, even though you might be a couple years older, you might be able to save some money on those policies. So it's something to analyze and look at there, and kind of dive into. So let's just see. I'm going to check the chat box here. Doesn't look like we have any questions on the insurance piece. All right. So this is kind of where I talk about, excuse me, getting a little dry mouth, is, when we go to the rodeo, what's at the end of the rodeo? We've got the bull riding, right? So with that, this is really kind of what gets people hot and heavy about wealth management and kind of the investment stuff is what are we doing? What are we talking about? Should we be investing in Tesla, Facebook, Amazon? What's cool? Well, the reality is everybody's going to be different. And there are a lot of things that people do that are kind of following the herd. And this is going to be kind of digging into the behavioral finance side of things. But we see headlines all the time. I subscribe to various websites or read them almost every single day. And they're investment websites, whether that's CNBC, CNN Money, Yahoo Finance, Wall Street Journal, Barron's, whatever it is. I like to read those because I like to see what my clients are seeing on a daily basis. Because a lot of the times, if you think about a free website, well, there is somebody behind that wants your click. And so there's a lot of clickbait stuff that really is going to be driving this. And this is what we would consider headline risk. Now, why I say this is that your investment strategy isn't necessarily good for your neighbor, and their investment strategy isn't necessarily good for you. And so that's something that it's incredibly personal, the investments that you do, because not everybody has the same risk tolerance. So today I want to talk about the investing waterfall, and this will get to, I think, Pat's question about about paying off debt and kind of how to really kind of think about it, managing risk, and then goals-based investing. And I'm going to kind of put those two things together, managing your risk and goals-based investing together under one roof. But basically, investments are very fun for me. That's kind of why I got into this business, is because in college, I was very interested in stocks and mutual funds and in ETFs and all the different things that go into it. And I started in the investment world at a very interesting time. And so why I say that is I started in the investment world in the summer of 2009. And so why I bring that up is that I walked into an atmosphere, and I want to equate it, and this is no disrespect to any of our war vets or anybody that served in the military, but I essentially walked onto a battlefield after the last bullet was shot. And what I mean by that is that if you look at when I started in the investment world, it was right after the Great Recession, or the bottom of the Great Recession. And I was meeting with people that had lost half, 3/4 of their savings, their life savings. And it really dawned on me that investing matters, and taking a very diligent approach to investing is the centerpiece of your life. And having the right habits and having the right strategy in place makes a lot of sense. So with that being said, that's kind of where I come from. Now, what is the investment waterfall or the investing waterfall? Everybody wants to dig into the investments right away. That's oftentimes when people come to me right away, they want to go, hey, where should I be investing my money? Is Facebook the right play? What are we doing here? Well, we need to kind of take a bit of a step back and look at kind of the bigger landscape. And so I look at this as, let's get rid of our debt, our bad debt first. All right. Why bad debt? So this is going to be like credit card debt, high interest rate student loans, things like that. This somewhat subscribes to the Dave Ramsey approach. I think he does it well. I think that there's some limiting beliefs that he puts on debt, but generally speaking, we want to get rid of bad debts first. Okay, so that's going to start. Once we kind of get rid of that, the bad debts, then we can start to think about saving. All right. This goes back to some of that financial vitality piece, is that when it comes to saving, we want to consider having some sort of an emergency account. What do we do in the event that you lose a job, you get laid off, where they're no longer able to work? You need to make sure that you have that quote unquote emergency fund in place. And so this is going to be the precursor to investing. All right. So when I say emergency fund, it's typically 3 to 6 months of living expenses. That's typically going to be a good way to bridge the divide. So let's just say you need $5,000 in monthly income to make your life work. Okay. Well, 3 months would be $15,000 in cold hard cash, and you don't look at investing that. And then from there, you can start to talk about the investment strategy. All right. So that's going to be, kind of the savings piece. The other side is, saving into a 401k. I see somebody asked about para, and I'll answer some of these questions here in a moment. But when it comes to the savings strategy, making sure that you're starting small, building that 401k or 457 or whatever the employer sponsored retirement plan is. Making sure that you have, you're there and you're getting practice in that. And then we jump into the investments piece. All right. So with the investments, this is where we can start to figure out what's your risk tolerance. Are you a really aggressive investor, or are you pretty conservative? And usually that can be fleshed out in a very short conversation. And honestly, if you don't have an appetite for the fluctuations, you're going to typically be a little bit more of a conservative investor. However, I will say that everybody, regardless if you're 75 or 25, really should have exposure to the stock market or the equity markets. And it just depends on what the percentage of your overall kind of investments are. But generally speaking, we need to consider growth, because growth, the stock market has done a great job of combating inflation. Now, today isn't going to dive into, the nuts and bolts of what's the difference between a stock and a bond, but understanding those as a financial education piece is going to be paramount to helping you navigate and transition over time. So with that being said, managing risk and using a goals-based investment approach. All right, so managing risk is again, what is your risk appetite? And it's pretty general. I mean, for me, I tend to be a little bit more of an aggressive investor, whereas my wife tends to be a little bit more of a conservative investor. And we have to navigate those things in our household, and that's totally fine. And so the investments that she chooses for her investments are very different than the ones that I choose for my own personal stuff. And the idea is that, over time, I believe that the market's going to go up. I will say this, and it's a little bit of a caveat, and I like to play this game a little bit with a lot of folks when they first meet me, especially when they're afraid of the stock market. So think about where you're going to personally be in 5 minutes from now. You're probably going to be listening to me drone on and on about personal finance. But let's just think about in a day from now. How about a week from now? A month? Where are you going to be in a month? Now, where will you be in a year? What does your life look like in 5 years? How about 10 years? what my point is that every level that we go out on the time spectrum of our life changes dramatically. We don't know. It's very uncertain. Our life in 30 years could be dramatically different than what we write down today. And my point of this is that the stock market works in the exact opposite way. What happens in the market tomorrow? I have no clue. What happens in a year? I could, I guess, put some educated guesses, but it's not any better than what the meteorologist has given you on the forecast. And then we've got 5 years. Well, it starts to get a little bit clearer after 5 years, after 10 years, 20 years, 30 years. So if you look at the S&P 500, that's going to be basically the 500 largest companies in the United States, generally speaking. And you look at that. If you go back to 1960, all right, the 25-year rolling average, the best 25-year rolling average, let me restate that, is a positive 16% return. So if you invested in the S&P 500 during that 25-year period, you would have experienced a 16% annualized growth. That will build your wealth very, very fast, okay? The worst is a positive 9% annualized return. That's over a 25-year period. So my point of saying that is that having a bit of a longer-term view of investing matters, and taking a little bit of risk actually can benefit you. You can offset that risk in a number of different ways by looking at different investments, but using growth and having a growth mindset when it comes to your investments is incredibly important. If you just took whatever you had left over at the end of the month, or that you saved at the beginning of the month, and you just put it in cash, well, it's going to be a lot harder process to build your wealth and to get to a point of financial independence. But if you invest that money in a safe and pragmatic way, and what I mean by safe is that you're aware of the risks that you're taking, then you can build that, and it can be the biggest growth vehicle over time. And so you can have that $1 million, $2, $3 million in net worth by the time you retire, which oftentimes people look at as that way to get to the, be able to retire and retire independently. So with that being said, that's kind of the approach and kind of my push in the sense of how do we want to invest and what's the best approach to do that. Managing risk is really important. I also use a goals-based investment approach. So I talk about, what is generally your feeling towards money? Is it risky? Is it conservative? More, I guess more aggressive, more conservative? That's really important. But it's also very important is, when do you need the money? So let's just play a game here and say that you are 40 years old. All right, you're 40 years old and you're saving in your 401k or an IRA. Those dollars are meant for retirement. And if you figure that the average individual retires around 65 years old, that's 25 years that this money has to grow. So then you start to consider, okay, what do we invest in? The number that I just used, the S&P 500 being, the best 25-year rolling period being up 16%, the worst is positive 9%. That would suggest that you should be taking a lot more risk, all right? And so when I say a goals-based approach is, when do you need the money? Because when you need the money further down the road, you can afford to take more risk, all right? If you need the money in a year from now, and I don't care if you're 25 or 45 or 65, you shouldn't really be taking a lot of risk on that money. It's regardless of your infatuation with being aggressive or conservative. If you need the money in a year from now, you shouldn't be risking that money almost at all. Now, it changes when you start needing it in 5, 10, 15 years. You can start to navigate the different investments and the different types of risks that you can take. And that's where we start to incorporate bonds and stocks and various other vehicles there. So I'm going to take a quick break here, and I'm going to go back to, I noticed that a bunch of questions have started to pop up about investing a little bit. Okay, Jennifer, I'm going to talk about the separate finances. I can talk about that here in a bit. All right.
Looks like it starts with where to get information about hybrid insurance options.
There we go. Okay, that's what I'm going for. Okay. So that's something that I could talk to you, Jessica, if that's something that you're interested in. I'll put my contact information. But if you've got a local life insurance specialist, that's somebody that would be really good to talk to. If you need somebody to, I do insurance, but I usually use a specialist for that. They're fantastic because they can work with various different companies, and they can get you put together in a very, very strong plan from an insurance perspective. So if you need some names, I'd be happy to do that. Universal, that they've held for 20 years, wondering if we continue to pay the premiums. Depends, Kelly, on how expensive those life insurance premiums are. If you stop paying your premium, it's going to start to eat away a little bit at the underlying cash value. So you just want to balance that. That's again where kind of taking a holistic approach to what that looks like is really important. And just being able to give you a reaction, I guess, it's something to look at. And yeah, so if you stop paying the premium, then it might make sense to look at investing that money elsewhere if it doesn't deteriorate the cash value. So Kaylin, I'm going to answer this one specifically to you because it looks like somebody had a question further down, and that is, should I transfer my retirement account from my previous employer to my current para? So this is actually kind of interesting. I've worked with a number of that are in the para system, and it depends on how much you're going to be giving up, and really, when do you plan on retiring? I found that if you're really closer to retirement, but adding that money to your para account, whether that's buying more years to get a higher payout, doesn't necessarily make a lot of sense if you're really close to retirement. But if you think that you're going to be in the para system for a long time, then it might make sense to buy some years or add to that para account. The other thing is that depending on the type of account, you could actually roll that into an IRA. Or a Roth IRA, depending on how you want to do it. And why I oftentimes advocate that is that in some employer-sponsored retirement accounts, be it a 401k, a 403b, a 457, the investment options are very limited into what the fund lineup looks like. Now, in this day and age, that's pretty, the fund lineups are pretty good. But I have seen some, especially with, maybe federal employees, they're very limited in what funds they can invest in. And so having, things that you can do outside of that with, to be a little bit more focused, or using a scalpel instead of kind of that butcher knife approach is really important. What free, reliable resources are out there for to educate ourselves about investing? This is coming from somebody that's coming in through as a number. The internet's amazing. You've got a lot of things that are out there, but there are absolutely some things out there. I like Investopedia. It's kind of like your encyclopedia of investing. But I'm going to start to, I think what we'll do is to actually move this to the end here. Looks like there's some really great questions that I'll actually touch on so we can get through the bulk of what we have here, since we're kind of wrapping things up here in a minute. All right, so behavioral finance. What is behavioral finance? Behavioral finance is it's a field of study that incorporates finance and psychology and sociology and combines these things together. So the godfathers or the founders of behavioral finance are Amos Tversky and Daniel Kahneman. And they actually have won a Nobel Prize for the work that they've done on behavioral finance. And basically what it's to say is that we generally are our own worst enemy when it comes to money. We make a lot of illogical decisions around how to invest, to save. And there's a lot of things that are out there that are very challenging because of the emotion that's tied to our money. And so when it comes to behavioral finance, there's some pitfalls that we can hit, whether that's headline risk. So what's going on the market, and all of a sudden, it depends on what's the hot bit, what's the hot stock of the day. I get calls from people all the time. Should I be buying gold right now? Well, gold just happens to be on a bit of a run here, excuse me, And so it's on a lot of headlines. And so I'm getting a lot of those questions. Or that in early March or late March, people are freaking out about the pandemic and the market's going down 25, 35% in some cases, and people are wanting to sell. Well, we know that as assets go down, they actually reduce, the risk of them reduces. I know that sounds a little bit counterintuitive, but the higher the price of an investment, the more inherent risk comes with it. So oftentimes people know that they should buy low, sell high, but our psychology tells us that it feels safer when we're buying in at a level that's a little bit higher. And so people they don't want to buy the bottom, and that it's been proven time and time again. And so I use the stock market as a device for transferring money from impatient to the patient. Now, Warren Buffett is a very famous investor, and he has taken a very diligent approach to building his wealth. There's a lot to be said about what he's done. Now, with that being said, he's absolutely right. We shouldn't be panicking when the market falls, okay? You're going to feel a pit in your stomach when you open your bank account and or your investment account, whether that's on Fidelity or Robinhood or whatever it is that you use. You're going to see this shock when you see some of your values if the market goes down. And then conversely, if the market's up, you're going to feel this level of elation and kind of this dopamine effect when you open your accounts, and you're going to feel really good. But the challenge is that that's awesome, but you actually need to navigate or manage the risk on the other side more importantly. Because if you're selling at the bottom, that means that you've got to make two decisions correctly. If you're going to sell when the market's going down, you've got to get that first sell correct, meaning you've got to be right, that there's more downside risk. The other challenge to that is that now you have a decision to make with the money that you have on the sidelines. When do you invest again? I have met a number of folks that sold their accounts in the summer of 2009. And it took them 5, 6, 7 years to even buy back into the stock market. And in that time, they realized all the losses and they didn't enjoy any of the gains of the market, because over time, the markets will go up. It's just a matter of being patient. I will use this. What can we learn from this fireman trying to catch the hose? Is that the end of that hose is the daily whipsaw effect of the market. It's going to go up and down, and there's a lot of noise to that. But as I talked about earlier with that experience of the 25-year experience, is that if you back up, the market gets less volatile. It gets less risky. Investing gets less risky. So think about taking a little bit longer term approach, but then managing your finances on a short-term basis, making sure that you've got a strong foundation, making sure that you've got enough cash on hand if something were to happen, making sure that your cash flow is in line with your expenses, things of that nature. And so really taking a step back here, if this gentleman were to just back up and not chase the tip of the hose, he would get control of that in a much better way. So one thing that I will tell you from a behavioral finance perspective is, if you can avoid it, don't log into your account every single day. I had a client that I gave him online access. He didn't ever have online access before. And he started checking his account every single day, multiple times a day. And I started getting more and more phone calls. What he didn't realize is that the pain that he was feeling from the down days was greater than the pain that he was feeling from the up days. And he called me after a couple months and he says, "Taylor, why are my investments performing so poorly?" And I said, "Well, what do you mean?" And he said, "Well, I just feel like we're down." And we actually looked at what his account value was between really the start of the year and when we were talking, and his account value was up significantly. But because of the feeling that he had, because the down days were affecting him greater than the up days were helping him, he felt like the portfolio was down. And that's something that we fall victim to all the time. And so I'll kind of wrap things up and talk about the shift from a scarcity to an abundance mentality. A scarcity mentality or a scarcity loop is driven by fear. Fear creates anxiety. Anxiety creates poor decisions, and then poor decisions result into negative outcomes. Those negative outcomes then continue with the fear, anxiety, poor choices, negative outcomes effect. You see this in a lot of people's lives, people that make poor decisions with the law, with money, that all of a sudden it's this snowball effect. And just as wealth can be built and snowball over time, bad decisions can be built all of the time as well. So why I say this, shift to an abundance mentality. Take gratitude in the things that you have. Take stock of it. Look at what you have and be very gracious and just have a lot of love and hope for what you have. And then that creates peace of mind, which then generates wise choices and positive outcomes. And so my challenge to you is shifting from that scarcity mentality to more of an abundance mentality. What to do now? Breathe, evaluate, plan, and execute. If you want to have a discussion with me, on the next page, I will provide my contact information, but then feed yourself with positivity, all right? There are a lot of ways to learn about investing. There's a lot of ways to understand, but sometimes it's just the people that you hire in your life. Understand who you're working with. If you don't work with anybody currently, it might be a wise decision to at least have a conversation, whether that's me or somebody in your own individual, in your community that you trust. Understand that what you're doing and what, the thing that you're doing is worth doing, and build that positivity. And then finally, stay engaged. I see a lot of people, really have the best intentions in mind, and then they just let their finances drift off to the side because life gets in the way. I want people to stay engaged with their life and get to wherever their destination is on purpose, not on accident. So with that, I really appreciate everybody's time and questions. I'm wrapping up just a couple minutes after 11 o'clock here. This is my contact information, taylor@4pointswealth.com. That's my email. You can call me at 303-910-9751, or you can also find me on the web at 4pointswealth.com. I am located in the Greenwood Village area, just off of I-25 and Arapahoe. So I'd be happy to schedule either an in-person phone call or Zoom call with you if you'd like to explore some of these additional areas. Again, a couple of convenient ways to connect, either phone or video conference. And with that, thank you so much. Ashley, is there anything else that you wanted to add before we start to get into the question and answer piece?
I just wanted to let everyone know that I will be sending a recording, like the access to the recording, to this afterwards. So later this afternoon, everybody who was in the session should get access to that, which it will also include your contact information. So just in case you missed a piece or your sound cut out or anything like that, you'll have that available.
Perfect. I love it. I'm going to dive into a couple of questions here. So I'm going to start going back a little bit. Okay, so I will go kind of, what do you consider aggressive stocks? Is there a way to work on investing without going to a random place where I have to trust? Okay, okay, Anna, I'm going to start with that. And I'm going to kind of just speak to kind of who I am. And this is a little bit of a plug for kind of something that you should look out for. So when it comes to going to somebody that you know, like, and trust is really, really important. Because you've got to understand that they have your best interest in mind. Now, sometimes I think about that from the bottom up and the top down. If you're working with somebody that you actually trust, that's from the bottom up. But understand if the company itself has your best interest. And so there are different companies out there that have a fiduciary responsibility. As a certified financial planner, if somebody chooses to work with me, I have a fiduciary responsibility to that individual. That's whether we're doing financial planning, whether we're doing insurance analysis, or we're doing investments. I have a fiduciary responsibility. In addition to that, the company, 4 Points Wealth Management, has a fiduciary responsibility to their client because it's a registered investment advisor. And so with that being said, you've got to know kind of the back end. And so this is where having that financial education piece can be very important. Annette asked, what do you consider aggressive stocks? So I would say that the tech stocks, by and large, are generally pretty aggressive. As an example, this is not a suggestion on whether you should buy it or not. Facebook would be considered an aggressive stock. Tesla would be considered an aggressive stock. There are a number of different things that are out there, but there are other companies out there that are, let's use the tech industry as an example. Microsoft might not necessarily be as considered as aggressive. They might be more considered because they've been around for a lot longer. That they might be more of a value type of company. They pay a dividend, albeit very small. They're not as growth oriented. They've been around their time horizon. Whereas a Tesla, they're out there for, trying to grow. And so you might consider them to be more aggressive. This one came to Ashley privately. And where are the best ways to shop for insurance, your bank, companies, or safeguards and questions? If this individual has questions, I'd be happy to field that. I find that having an independent insurance specialist that does life insurance specifically does that. I've got a company that I work with that's what they do, that they're life insurance specialists. Why I like the independent side of that is that they're not captive. So they can go to a Pacific Life, National Western. There's thousands of insurance companies out there, but getting an insurance company that is really highly rated is very important. So understanding that. The stock market makes me nervous. There's a lot in this. I'm going to jump to a Roth question because it looks like we've had a lot of Roth questions. All right, so the stock market makes a lot of people nervous. But I believe that investing at least some of your money in the stock market is incredibly valuable. Now, should not be money that you need tomorrow, or shouldn't be necessarily money that you feel like you need to lean on, because something might happen to you and you don't want to get a down day. As an example, let's just use March as a time frame. March, the stock market was in the doldrums. It was in the pits. It was a really bad time. If you had to take your money out in early to mid-March, you were in a really bad place, okay? So my point is that the money that you invest in the stock market shouldn't necessarily be money that you need, tomorrow or a year from now, because the fluctuations can be so high. If you need it in 5 years, sure, that's a great way to do it. But always having that safety net of cash on hand is really important. Is it possible? Okay, All right, so I'm going to jump into the difference between, one thing we didn't talk a lot about is taxes today. So I want to just dive into that just briefly. A lot of people in the chat mentioned the difference between a Roth and a traditional IRA, or a Roth 401k or something like that. And I'm going to give you the basics of what that is. So a traditional IRA, as an example, is a individual retirement account that would be, as the name suggests, for retirement purposes only. So you have limits on how much you can put in that account every year, and there's income restrictions and things like that. But the beauty of a traditional IRA is that you get a tax benefit today. So my example here is that if you put $5,000 in a traditional IRA and you make $100,000, the IRS would look at that and they would say that you made $95,000. You wouldn't be taxed on that $5,000 income. Now, at retirement, that $5,000 is going to grow over time. But at retirement, the entire amount that you're taking out is going to be taxed at ordinary income levels. So Uncle Sam is going to be a partner in your IRA. That's for better or worse. So if you have $1 million IRA, expect that about $700,000 of that is yours and $300,000 of that is the IRS's. So understand the tax ramifications of what you're doing. On the flip side, there's a thing called a Roth IRA, and in more recent times, a Roth 401k. So a Roth IRA is kind of the opposite. You don't get a tax benefit today, but what happens is when you invest into an IRA, or a Roth IRA specifically, you don't get a tax benefit, but that money that you invest grows tax-free. And if you follow the rules, the distributions on that are going to be tax-free. So the idea is that you're going to be paying taxes on that. Let's just use the $5,000 as an example. You'll be paying tax on that $5,000 today. But at retirement, you will have already paid the tax, and you will not be exposed to taxation in the future. So that can be a huge benefit, especially for younger workers. If you've got 10 to 15 plus years till retirement, a Roth option could be a fabulous way to save for retirement so you can generate tax-free income in retirement. So with that, I often talk to my clients about creating tax diversification. When it comes to investing, we didn't really talk about this, but we've got to have a diversified portfolio. Well, when it comes to taxes and retirement, it's also very important to have a diversified portfolio. So with that being said, consider the taxation and the various streams of income that you might have in retirement, because a Roth versus traditional is very worth having that conversation, because it's like when you having a Roth is paying tax on the seed as opposed to the crop. So have that in the back of your mind. Let's see here. So it looks like we're kind of wrapped up on questions. I'll give it just a couple minutes here. Is there any other questions that we have from the audience?
There's one, and I'm not sure if maybe you touched on it and I missed it. Would you recommend separate bank accounts for married people, or is that?
Thank you. I'm glad you brought that up, because I said I would touch on that. I have a bit of a bias here, and my bias is that I've seen far too often where separate finances can hurt the family unit in the long run. It usually comes from families that are what I would consider blended families, so second marriages or something like that, where, and especially if kids are involved. But generally speaking, I think that there should be some cohesion within the family unit from a financial perspective. And the reason for that is that it creates accountability. If a husband and wife, as an example, come together in a marriage or in a relationship, and they don't have shared finances, or at least have a really deep understanding of the other person's financial situation, then it can create levels of hiding. And what you don't want to do is have that lack of transparency between the two spouses. So my belief is, generally speaking, have shared finances, or at least a shared bank account where general expenses are used. My wife and I, as an example, have different credit cards, but we are generally we know kind of what we're spending money on. Everything is kind of open there. So from that perspective, all of our money pools together, and it's very, transparent in that sense. So, but that more or less goes back to, where things were way back when. So I would say, generally speaking, having at least a deeper understanding of each other's finances is important, if not altogether together. Anna, thank you. Yeah. So just as a quick recap, as we kind of wrap things up here, there were a lot of things that we touched on. We'll go back to the beginning here, and I'll share that. All right, we're almost there. So some of the wealth management basics: understanding financial planning, why it's so important, investment management, financial education, and ongoing engagement. The wealth building basics: having your income be greater than your expenses and investing the difference. Not just necessarily saving, that's important, but ultimately investing that difference, because it's investing, and the time value of money growing over time is highly important. Insurance: why is it so important to have insurance? Because you want to make sure that you're protecting what you already have. And then finally, investing: what makes sense for your investing life, what strategies work for you. And again, your neighbor's investments aren't necessarily right for you, and vice versa. So make sure that you have a plan and investment strategy that's specifically built for you and your family, or what goals you want to ultimately achieve. That's highly important. Using a goals-based approach, having a plan. If you want to, send a kid to college in 15 years, what does that look like? What kind of plan in investments do you need to have? If you want to retire early, or just retire at all, what does that look like? So making sure that you have that piece. And then the behavioral finance piece, is incredibly important. Try not to be your own worst enemy. Recognize, put safeguards in place. Do automatic saving, do automatic types of investments. Make sure that as much of that can be kind of put on autopilot, so you don't have to make an emotional decision, an invested decision every single time you want to invest or save money or something like that. That oftentimes plays to that. So understanding kind of the biases that you approach money with, and then ultimately having an abundance mentality around money as opposed to a scarcity mentality. That's going to help you and create good, solid relationships with money over time. So with that, is there anything else you would like to add, Ashley?
No, I think that was the last of it. I appreciate it. And feel free, anyone, if you want to reach out specifically to Taylor to kind of just throw out your question that maybe you didn't have a chance to get answered today, please reach out.
Awesome. Yes. And again, email is taylor@4pointswealth.com.
Awesome. Thank you so much, Taylor. I very much appreciate your time with us today.
And I appreciate you having me on, and it's been a very fun experience.
Yeah, anytime. And hopefully
Thank
we'll get some other people, and I'll copy you in the email today too that we send out with the recording so that you have access to it as well.
That sounds great. Thank you so much, Ashley.
Yeah, thank you everyone.
Thank you both.
Have a wonderful rest of your day.
Bye-bye.